Imagine just, purposely walking away from almost $500 million in guaranteed revenue.
Mm.
Like just completely turning off the tap on this massive cash flow that your company has relied on for years.
Yeah, for most businesses, that sounds like an absolute death wish.
Right. But today, we are looking at this masterclass and how a company fundamentally rewires its own DNA, taking a massive, highly calculated hit to the top line in order to secure its future. Welcome to the deep dive, by the way.
Glad to be here. It's an incredibly bold case study in corporate strategy. We're digging into the June 2026 earnings report and the investor presentation for G-III Apparel Group.
Specifically, we're looking at their Q1 results for fiscal year 2027. And really, the mission for this deep dive is to understand the actual mechanics of a high-stakes business transformation.
Exactly. Because for years, if you looked at G-III, they were an absolute powerhouse operating largely on, well, what we could call rented mega licenses.
Yeah, they were manufacturing and distributing and selling clothing under other people's incredibly famous brand names. But the overarching theme of this latest quarter is this hard, aggressive pivot away from that rental model and toward actually owning their own global brands.
And the difficulty there is that transitioning a conglomerate of this size is just a logistical nightmare. I mean, you are dealing with massive supply chains, global retail partners, and, entrenched consumer expectations.
Oh, for sure.
Changing that core business model requires intense operational discipline because your margin for error is essentially zero.
Which is exactly why this is so relevant for you listening, whether you're navigating a career pivot or trying to change the direction of a small business or just, rethinking how you allocate your own time.
It's universally applicable.
It really is. G-III's recent quarter is a blueprint for ripping off the Band-Aid. They lost major revenue streams on purpose. They endured the immediate friction of that loss, and yet their stock outlook and underlying financial health are actually improving. Okay, let's unpack this.
Sounds good. Where do we start?
Let's start with the immediate reality of their Q1 numbers, because the surface-level data presents a really fascinating paradox here.
Yeah, you see a company reporting shrinking total sales, but at the same time, they're raising their financial expectations for the rest of the year.
It's wild. Let's lay out the scale of this. So for Q1 fiscal 2027, G-III's net sales were $536 million. That's an 8% decrease from the $584 million they pulled in during the same quarter last year.
Right.
Breaking that down, their wholesale business, so selling to department stores and other retailers, brought in $515 million, while their own retail sales were $41 million. But the crazy part is that despite this 8% overall drop, these numbers actually came in ahead of the company's own internal guidance.
Yeah, the drop itself wasn't a surprise to them at all, nor was it caused by some, sudden lack of consumer demand. The 8% decline was the mathematical result of a planned strategy.
The intentional loss of PVH brand revenues.
Exactly. We were talking specifically about stepping away from the Calvin Klein and Tommy Hilfiger licenses.
Okay, wait, I need to push back on this logic for a second.
Go for it.
If I'm running a massive fashion conglomerate, and I just actively decided to walk away from approximately $470 million in expected annual sales generated by Calvin Klein and Tommy Hilfiger, shouldn't I be panicking right now?
You think so, yeah.
In any normal scenario, losing nearly $500 million in guaranteed revenue feels like trading away your star players right before the playoffs.
Yeah.
How does leadership spin that as a positive?
What's fascinating here is that sometimes shrinking the top line, like the gross amount of money coming through the door, is actually the only way to drastically improve the real health of the business overall.
Really?
Yeah, you have to stop looking at the sheer volume of sales and start interrogating the quality of those sales.
Okay, quality of sales sounds like a phrase an accountant uses to make bad news sound good. What does a high-quality sale actually look like in the real world of apparel?
It fundamentally comes down to selling a garment for the price on the tag, rather than constantly discounting it. In this Q1 report, G-III noted a very meaningful increase in full-price sales.
Ah, I see.
Because when you operate under a rented mega license like Calvin Klein, the economics are just brutal. You owe the licensor enormous royalty payments. And to cover those royalties and still actually make a profit, you are forced into strict volume expectations.
Meaning you just have to churn out inventory.
Right. You have to manufacture and push colossal amounts of product out the door. And when you flood the market with that much volume, a lot of it inevitably ends up on clearance racks or sold to discount retailers.
Right, because the supply outstrips the demand, and suddenly your product is always 40% off.
Precisely. So by shedding those massive licenses, G3 certainly took a hit to their total sales volume. They're just simply moving fewer physical shirts and dresses. But the items they're selling are moving at full price. They're relying significantly less on markdowns.
Okay, that makes total sense. It's like the classic real estate analogy, right?
Ah.
Renting an apartment means you can move in tomorrow and have a flashy address, like having the Calvin Klein logo on your balance sheet. But you build zero equity, and the landlord dictates all the terms.
Yeah, that's a great way to look at it.
Whereas building your own house requires a massive upfront investment and, a lot of painful construction. But once it's built, you capture all the value. Which brings us to the core of G-III's new strategy. CEO Morris Goldfarb calls it disciplined ownership.
Yeah, that phrase is the absolute thesis for everything they are doing moving forward.
But if they're deliberately creating a $500 million hole in their portfolio by dropping these rentals, the pressure to replace that revenue has to be immense. So what actually fills that void?
The focus shifts entirely to the brands they actually own, and this transformation is already well underway. According to Goldfarb's strategy outlined in the report, G-III's owned brands now account for more than 60% of their total revenue. Yeah. If you look back at fiscal 2020, owned brands were only about 40% of their business.
A 20% shift in the structural makeup of a billion-dollar company is just massive. And I mean, the undisputed crown jewel of this new owned era is their recent acquisition of the iconic Marc Jacobs brand, right? A deal they put together in partnership with WHP Global.
Exactly. The Marc Jacobs acquisition acts as an aggressive catalyst here. It doesn't just replace the lost revenue. It instantly elevates the prestige of their own portfolio and opens up long-term growth opportunities across completely new product categories and geographic regions.
Right.
But acquiring a shiny new asset is really only half the battle. The true test of this disciplined ownership is what they're doing with the legacy brands already in their stable.
And looking at the brand highlights from the quarter, the underlying mechanics of how they're reviving these own brands is really striking. Take Donna Karan as an example.
Yeah, they had a great quarter.
The brand delivered approximately 40% growth in Q1, and the report attributes this to strong average unit retail, meaning the average price a customer pays for an item went up, and very healthy sell-throughs. The standout metric, though, is that sales on the Donna Karan website jumped nearly 60%.
That is huge.
Plus, they're gearing up to launch a new Intimates license for fall 2026.
Right, and that 60% spike in website sales is really the most critical data point for Donna Karan. It proves they're successfully driving direct-to-consumer engagement.
Because the margins there are so much better.
Exactly. In the wholesale model, you sell a dress to a department store at a massive discount, and the department store captures the retail markup. But when you drive a customer directly to your own website, you capture the entire margin. You cut off the middleman entirely.
Which explains the push we're seeing across their other properties, too, like DKNY. They reported double-digit store comps in North American direct-to-consumer channels. The DKNY website was also up over 40%.
They're pushing hard on all fronts.
Yeah, even physical retail, opening a new flagship store in Shanghai. But as a consumer, what really caught my attention was how they're driving all this traffic. They ran this massive spring 2026 campaign led by Hailey Bieber.
Oh, yeah.
The report notes it drove high engagement and significantly broadened their global awareness.
It is a textbook example of leveraging modern cultural capital. And we see the exact same blueprint applied to Karl Lagerfeld. The brand performed exceptionally well in North America through direct-to-consumer channels.
And they're cracking difficult international markets too, right? The report explicitly mentions that despite a very challenging macroeconomic environment in Europe, they managed high single-digit growth in Karl Lagerfeld jeans, which targets a much younger demographic.
Yeah, and how did they do it? Another massive cultural swing. They partnered with Paris Hilton for a global campaign that generated record-breaking engagement across digital, social, and experiential platforms.
I mean, notice the common thread here. Hailey Bieber for DKNY. Paris Hilton for Karl Lagerfeld. When you own the brand, you have the freedom to invest heavily in top-tier marketing because you control the messaging and, more importantly, you capture all the downstream profit.
It changes the entire risk-reward calculation.
Totally. Because if you pay Hailey Bieber millions of dollars to promote a rented brand, a huge chunk of the resulting sales just goes to paying the licensor's royalty fee.
Right.
When G-III does it for an owned brand, every single dollar of profit generated by that viral campaign stays in their own bank account.
Exactly.
So what does this all mean for their profitability if they are controlling the brand destiny rather than just renting the name? Because high-profile marketing campaigns are incredibly expensive. Transitioning a supply chain away from wholesale and toward direct-to-consumer is incredibly expensive.
It is. To understand that, we have to look really closely at the financials, and I will warn you, this quarter features one of the most unusual accounting anomalies you are ever likely to see in a standard earnings report.
Oh man, when I first read the net income figures, I literally thought there was a typo. The gap between the official numbers and the underlying reality is immense. Let's peel back the financials because right in the middle of this report is a staggering $102 million surprise.
Yeah, we need to establish the baseline here by comparing the two ways companies report their earnings, GAAP and non-GAAP.
Right.
GAAP stands for Generally Accepted Accounting Principles. It is the rigid, standardized set of rules mandated by regulators. Non-GAAP figures, on the other hand, are adjusted by the company to filter out one-time, extraordinary events. The goal of non-GAAP is to give investors a clearer, normalized picture of how the day-to-day business is actually running.
Okay, so looking at the official rigid GAAP numbers, the net income for the quarter was a massive $66.5 million. That translates to a $1.50 per diluted share. If you compare that to the exact same quarter last year, they only made $7.8 million.
It's a huge difference.
So on paper, using official accounting rules, G-III's profit just skyrocketed by almost 800%. They look like they discovered a gold mine.
But then you flip the page and look at the non-GAAP numbers, which strip out the anomalies. The non-GAAP reality is that they actually operated at a net loss for the first quarter of $8.7 million.
Yeah.
Last year, that non-GAAP number was a positive $8.4 million.
That is just a head-spinning contradiction. The official record says they made $66.5 million in pure profit, but the adjusted reality says they actually lost $8.7 million running the business. To understand how that is even mathematically possible, we have to look at the gross margin.
Okay.
Their GAAP gross margin, which is simply the difference between what it costs to make the clothes and what they sell them for, jumped by an unbelievable 2,270 basis points to reach 64.9%.
Right. And for context, a single basis point is 1/100th of a percentage point. So a 2,270 basis point jump means their gross margin increased by nearly 23 percentage points in a single quarter.
That's insane.
In the apparel industry, a margin jump of that magnitude does not happen through normal operations. It is mathematically impossible just from selling shirts.
So the culprit behind this massive swing is what the earnings report categorizes as a $102.7 million pre-tax benefit. This isn't money they made from selling clothes this quarter. This is a massive windfall from the expected recovery of previously incurred IEEPA tariffs. Basically, tariffs they previously paid on inventory that they already sold last year.
Exactly.
And when you factor in taxes, it nets out to a $77.9 million benefit hitting the books all at once.
Oh, and the accountants also excluded $3.4 million in expenses directly related to acquiring Marc Jacobs from the non-GAAP numbers, just to keep the day-to-day operations clear.
Yeah. The IEEPA tariffs, that's the International Emergency Economic Powers Act, are the key here. G-III paid exorbitant government tariffs on imported goods in the past. And through ongoing legal and administrative processes, they're now getting that money back.
I mean, it is the ultimate corporate equivalent of reaching into the pocket of a heavy winter coat you haven't worn since last year and pulling out a literal $100 million bill.
It is found money, but as amazing as that is for their bank account, it completely obliterates any clear view of how the actual clothing business performed over the last 3 months.
It absolutely skews the headline numbers. And as an observer trying to understand the health of the transformation, you have to mentally set that $102 million windfall aside. You just cannot evaluate a business strategy based on a one-time tax refund.
So let's do that. If we strip away the magic $100 million coat money, and we ignore the artificial boost to the bottom line, what does the underlying engine of the company actually look like?
Well, if we connect that to the bigger picture, the real triumph of this quarter is found in the adjusted gross margin. Even when you completely exclude that massive tariff benefit, their non-GAAP adjusted gross margin still increased by 350 basis points.
Okay, wow.
Yeah, it rose from 42.2% last year to a very healthy 45.7% this year.
Meaning that for every dollar of clothing they sell, they are keeping 3.5 cents more in profit than they did a year ago, purely from operational efficiency.
Exactly the mechanism we want to see. That 350 basis point increase is the absolute tangible proof that the owned brand strategy is working. It justifies the terrifying decision to drop almost $500 million in Calvin Klein and Tommy Hilfiger revenue.
Because they're making up for it in margins.
Right. The expanding margin proves they're executing on the strategies we discussed. They're successfully selling at full price, they're strategically shifting the mix toward their higher margin owned brands, and they're managing their inventory with ruthless precision.
And that margin expansion is strong enough to absorb the rising costs of this transition, too. The report shows their selling, general, and administrative expenses, their SG&A, which is essentially the back-end cost of running the business, paying salaries, running those massive marketing campaigns, went up to $255 million from $231 million last year.
Yeah, the transition costs money.
But because they are making so much more profit on every individual item sold, the underlying engine is actually running hotter and more efficiently than before.
That is the defining hallmark of a successful structural pivot. The core unit economics are improving. Which leads us to the ultimate question. How are they positioned to survive the rest of the year while this transformation plays out? Well, building a house from the ground up takes serious capital. With the core business health validated, again, ignoring the tariff windfall, we have to look at the war chest they've assembled. Their fortified balance sheet and their outlook for the rest of fiscal 2027 are incredibly revealing. They are operating from a position of immense financial security. G-III ended the first quarter with a cash position of $394.2 million. That is a substantial increase from the $257.8 million they held at the same time last year.
And that's just cash on hand. The report notes they have total liquidity and availability of over $800 million. They are so comfortable with their cash flow that they even paid out $4.2 million in dividends to shareholders during a massive structural transition.
There's a lot of confidence.
But the single metric on this balance sheet that screams operational discipline to me is their inventory level. Their inventories are actually down 8%, sitting at $417.8 million compared to the prior year.
We really cannot overstate how critical that inventory number is. In the fashion industry, excess inventory is toxic. If you manufacture too many clothes and they don't sell, they take up expensive warehouse space.
Right.
And eventually, you are forced to slash prices just to get rid of them. That destroys your gross margin, and worse, it cheapens the perceived value of the brand in the eyes of the consumer.
It totally does.
So the fact that G-III managed to reduce their inventory by 8% while simultaneously expanding their gross margin by 3.5 percentage points shows masterclass level supply chain management. They're buying smarter, bringing exactly what they need, and selling it at full price.
It is incredibly rare to see a retail company achieve that trifecta: shrinking inventory, rising cash reserves, and climbing profit margins. And that confidence is fully reflected in their raised guidance for the full fiscal year 2027.
Right. Looking ahead, they're projecting net sales of approximately $2.71 billion for the year. And it's crucial to remember that this top-line figure fully absorbs the planned loss of that $470 million in PVH brand revenue.
They are swallowing a massive revenue loss, but because the remaining business is so much healthier, their profitability metrics are actually going up. They expect their adjusted EBITDA, which is a measure of core operational profitability before interest, taxes, and accounting adjustments, to be between $178 million and $182 million.
Very solid.
More importantly, they raised their non-GAAP earnings per share guidance. They now expect to make between $2.15 and $2.25 per share, which is a noticeable bump from their previous outlook.
They do note some headwinds, specifically that their non-GAAP tax rate is expected to be relatively high at roughly 33.5% due to certain non-deductible expenses, and they're projecting net interest income of only around $2.0 million. But the overarching narrative of this guidance is aggressive confidence.
And here's where it gets really interesting. This updated, highly optimistic fiscal 2027 outlook doesn't even factor in the pending Marc Jacobs acquisition.
Oh, wow.
Yeah, all of this raised guidance is based entirely on the current existing portfolio performing better than expected.
It signals that the core engine of the company, DKNY, Donna Karan, Karl Lagerfeld, has generated enough internal momentum to pull the entire conglomerate forward, even before the new crown jewel of Marc Jacobs is fully integrated into the accounting. CEO Morris Goldfarb's closing thoughts in the presentation perfectly synthesize why this matters.
How does he frame the end goal of all this disruption?
He frames it not as a survival tactic, but as an intentional evolution. He emphasizes that navigating away from Calvin Klein and Tommy Hilfiger is allowing them to build a portfolio of premium brands where, and this is a key phrase, creative identity, cultural relevance, and pricing integrity are protected and enhanced through disciplined ownership.
Disciplined ownership. That is the thread connecting the Hailey Bieber campaigns,
Yeah.
the 8% drop in inventory, and the willingness to walk away from $500 million in easy revenue, which really brings the lessons of this corporate boardroom directly back to you, the listener, because the mechanics of this transition are universally applicable.
The fundamental shift from renting your success to owning your assets.
Precisely. In your own life, whether you are charting a career path, building a freelance business, or investing your time, there's a profound difference between renting and owning. G-III relied on other people's brand names for years. It paid the bills, it was lucrative, but they ultimately didn't control the foundation they were standing on.
Right.
When you make the difficult pivot to owning your own assets, developing your own unique skills, building your own independent brand, owning your own intellectual property, it usually hurts at first. You might see a massive dip in your personal top-line revenue, just like G-III losing $470 million. But over time, the margins improve. The quality of your output goes up, and the control you have over your own future becomes infinitely stronger.
Letting go of a comfortable rental agreement requires a high tolerance for immediate friction. But as the climbing margins and fortified cash reserves in this report prove, the long-term payoff for enduring that friction can be immense.
It is a phenomenal reminder that sometimes you have to shrink to grow. Which leaves us with a final, slightly provocative thought to mull over, especially as we watch GIII integrate Marc Jacobs into their portfolio. In an era where fiercely independent fashion labels are constantly being swallowed up by massive publicly traded conglomerates, what actually happens to the raw, chaotic, creative identity of a brand like Marc Jacobs when it gets plugged into a highly disciplined, margin-focused, inventory-shrinking machine like G-III?
That's the big question.
Does the art inevitably suffer to serve the balance sheet, or does achieving total financial discipline actually give designers the ultimate freedom to thrive? Keep questioning the world around you, and thanks for joining us on this deep dive.